Hello, I'm Chris Pedersen, and this is Stockwatch on Wednesday, the 24th of April, 2024. All information is general advice and may not be suitable for you. Always consult your advisor before making any investments. All questions from viewers should be sent to stockwatch@fnn.com.au. Here are a few of my market observations. War did not start from the volleys back and forth between Israel and Iran. This is a major sigh of relief. Markets, accordingly, are settling into a slow, gradual increase. Iron ore and copper are keeping their gains. Now, I've mentioned before about iron ore that I feel it's in a trading range between maybe 95 and 115. Right now, it's a little bit above 115, which is positive. Today at 11:30, inflation numbers came out. These are what they are. The CPI quarter on quarter was actually 1%. Consensus expected 0.8%. So that's a miss. That's bad. Trimmed mean quarter on quarter, exact same numbers. 1% actual, consensus 0.8. Now we look at the year on year. The CPI came out 3.6% up for the year. The market was expecting 3.4%. The trimmed mean was worse. It came out at 4%, expectation was 3.8%. So what does this tell us? Well, 1, don't expect a rate cut anytime soon. 2, equity valuations are not going to be going up because the interest rate used on discounted cash flow calculations is not getting smaller. Overall, the ASX today is absorbing this. Initially it was down, but it's rallied some since then. It is still down from 1129, but it's not nearly down as much as it was a few minutes later. This chart shows GDP change in the top 10 countries. The reason I'm showing you this is we're always looking for places to invest, and things like this help us focus on where maybe we should dig a little deeper. India, the past 10 years, GDP has increased over 80%. That's phenomenal. That is the biggest increase of any major countries. Although some would say India is still an emerging market, but it's a very large emerging market. India per capita growth is also extraordinary. Thus, taking a look at where to invest, maybe buy some ETFs in India for the long haul. I was asked a couple of weeks ago for an investment club meeting, what would be a good investment that somebody can make set and forget for the next 100 years? Well, that's a complex question. I have a very detailed answer, but I'm not going to give it today. But I will say that you do look for indices in areas that have growth. Thus, India is one of the first places I would look at for buying the index, for parking some of my long-term funds. This chart shows the top 10 stock exchanges in the world by total value of companies listed. This is February 24th, 2024. Saudi Arabia is included. It's around 3 trillion US dollars. Australian Stock Exchange is not on this list. About 10, 20 years ago, it was on this list. Things have changed. 3 companies today. The first one is Telix Pharmaceuticals. Code on the ASX is TLX. It's trading at $14.69. It caught my eye last week when it's trading at about $12.75. But, I only give this show once a week. Take a look at this chart. This tells you everything you need to know about this company. It is on a trajectory upwards. This is much better than sideways, down. This is a company that I would definitely put money into. Now, let's look at the numbers though, because if the ratios show it's expensive, then maybe you don't put as much into it. First of all, the price target I have is $19.15. It has a market cap now of about $4.5 billion. So this is not some small company. The revenue growth from 2024 to 2027 is estimated about 26% per annum. Now you notice I'm starting at 2024. That's because 2023 is a much lower number, and it would give you a deceptive feel that this company is actually growing significantly more than 20% per annum, but this 26% is an amazing figure nonetheless. The EPS growth in this same period is 68% per annum. It doesn't pay a dividend, which for high growth companies, that's perfectly fine. They're plowing the excess cash flow back into research and development. The PE on the 2026 earnings per share estimate of 48 cents, now this estimate's a little bit on the low side, some brokers are around 50 cents, is 30 times. So for a company with this growth rate, 30 times is a pretty low PE. The yield, it has no dividend, so no yield. Free cash flow is around 4%. Payout ratio, well, again, it doesn't pay a dividend, which is positive for these type of companies. Their focus is on radiopharmaceuticals and associated medical devices. What this really means is drugs are conjugated with radioactive molecules and inserted into your body. This is a big new area for oncology, which is cancer drugs. I rated a buy. Next company, Bank of Queensland, BOQ. They reported last Wednesday, you might remember. Today the price is at $6.16. Well, this is a long-term chart going back to like 2007. I went a lot longer than normal because I wanted to give you a big, long picture of how this company is performing. And it hasn't been good. It's actually been a company that I've been waiting for it to turn around and go up, because Queensland has high population growth. It's got good demographics. You would expect Bank of Queensland to be a stellar performer. But it just keeps getting bad management in the view of most analysts. So now let's look at the numbers that came out after the report. First of all, 12-month price target is around $5.48. This is looking at UBS price target, Citibank, Goldman Sachs, Jardine, Morgan Stanley. None of these brokers had much good to say about them. The revenue growth from 2024 to 2026 is estimated -1% per annum. Now I'm using 2024 because 2023 numbers are just atrocious and maybe not a fair picture of the company. Earnings per share in the 2024 to 26 period is 11% per annum, estimated. And the dividend growth is estimated in this period 8% per annum. Looking at the numbers here, the Bank of Queensland PE on 2025 earnings estimate of 43.5 cents is 14 times. Now let me drill into this a little bit. Based on ASX 200 overall, 14 times PE is low. However, the bank sector typically is a lot lower. In normal times, banks trade 11 to 12 times PE. And then you have CBA, which typically trades at a higher PE, like 13 or 14 times. So with Bank of Queensland trading at 14 times, this is overvalued on a historical measurement for banks. The yield on the 2025 dividend estimate of 31 cents is 5% yield. I think that yield should be a little bit higher for a company like this. The book value per share, according to UBS, is $7.25. So from a value investor, Warren Buffett would say, well, geez, it's trading below book value. This might be attractive. He would really drill into it. Well, I recommend the same thing. Really drill into it. The payout ratio is 77%, which means they don't have a lot of room to expand their dividend payout to increase their yield. Suncorp just bought ANZ. A leading mergers and acquisition expert told me this morning that what this really means is ANZ is now positioned to grow in Queensland, chipping away at Bank of Queensland market share. Well, that's making an assumption that the large banks actually are very good at grabbing market share and being able to take advantage of what they just bought. A couple of clients of mine who were CFOs of larger banks, Westpac and NAB, they told me never be surprised at how large banks can make an acquisition and fail to integrate it into their core businesses, nor be able to grow it. So we'll see on this. But we do know that ANZ is going to try to increase their share. Now, What I have from experience is that Bank of Queensland right now has come out with poor results, but when you look at the earnings growth estimates by brokers, that this company looks like it's turning around, even though nobody thinks it is. I personally feel that because of the PE at 14, it's a little pricey, so I rate it neutral. However, if Bank of Queensland drops to maybe around $5.50, then on a PE basis and on a yield basis, this company's a buy and can maybe reverse from its decades of poor performance. Last company is MAAS Group. Code on the ASX is MGH. Not many people have heard of it. They should. It's a very solid company right now in the right sector at the right time. The price is $4.43. Looking at this chart, yes, during COVID, they performed poorly. It's a building contractor, building equipment. They're into residential, commercial, you name it. And what you see is they got hurt, but for the past year and a half, past 2 years, they've been performing very well. Here is MAAS, M-A-A-S, their revenue by division. This is fascinating. It gives you a good picture of what this company does. Now, looking at the numbers, these are estimates from Morgan's Stockbroking, by the way. There's a market cap of around $1.5 billion. Price target is $5.15. So that's a decent amount of upside potential here. Revenue growth from 2023 to 2026 is estimated 18% per annum. And the earnings per share growth during this time is 23% per annum. And the dividend growth is only 7% per annum. I'll come back to that in a minute. The PE on the 2025 earnings estimate of 31 cents is only 14.3 times. And the yield on the 2025 dividend estimate of 6.8 cents is only 1.5%. It has very solid free cash flow, 7.5%, and the payout ratio is only 25%. So as I mentioned, they're into residential, commercial construction. The reason they have a low payout ratio and low yield is because they have a high level of debt. It's 2.2 times EBITDA. So they're plowing their profits back into the balance sheet, reducing debt. That is smart. It's strengthening their balance sheet while continuing to grow. With these growth rates, a PE of 14 times is very cheap. I rate this a buy. And because of the demographics, shortage of construction right now, they're perfectly placed to achieve these estimates. As always, if you want to learn more about anything I covered today, send an email to stockwatch@fnn.com.au and direct it to me, Chris Pedersen. Hope you have an excellent week and that it's profitable. Thank you.